Howdy guys, and welcome to our video on Introduction to Income Statements. Again, the purpose of this video series is to introduce the learner to forms of financial communication such as financial statements. Again, this is not in-depth accounting. We're not trying to make accountants out of anybody here. This is more to make sure that as an operator you understand what's going on in the financial statements. In this video, we're talking about income statements. The outline for this video, we will talk about the importance of income statements, the elements of the income statement, and we'll have a little discussion about what profitability is as it relates to the income statement. Let's look at a sample income statement that we'll work off of for this video. This sample income statement you can see here with a net income of 23, down bottom line number, net income of 23,764. That is actually 23,764,000, round because it's rounded to the nearest thousand, and expressed that all numbers are expressed in thousands. So we'll talk a little bit more about that, but this is the sample that we'll use through the video. The purpose of the income statement is to report the results of an operation based on revenue and expenses over a certain period of time. Catch that it's a period of time. As a contrast, when we look at the balance sheet actually expresses numbers at a certain point in time, where this covers, again, a period of time. It's been said that accounting is the official language of business. With that in mind, the purpose of the income statement in essence is to tell the story where the balance sheet sets the scene. In the income statement, revenues and expenses are reported when realized. In other words, an event has occurred, not necessarily in line with the receipt and disbursement of cash. Here's what I mean by that. From a distributor's perspective, a customer orders a product and they have an account. They get the product, they don't necessarily pay for it. Then they've got some period of time, say 30 days, to pay for it. Even though the customer has not paid for the item, we would still recognize that as revenue on the income statement. The simple formula is revenue minus expenses equals our net income. Elements of the income statement. And again, we'll use the example that we presented. Unit of measure. So the first thing to catch, as we presented a little bit earlier here, is that the unit of measure informs the reader as to the size of the numbers. So for example, right here you can see all numbers in thousands. So what that basically means is that the 840,000 that's represented in net sales actually equates to 840 million. The next element is the period covered. You can see here year ending and the day that this statement covers. So see a couple of things. It's the ending date of the time period covered by this financial statement, and then it also indicates the amount of time covered. Here it says year ending, so that would be annually, but it could also be quarterly, monthly, etc. The top line number presented in this financial statement is net sales. Net sales equals total revenue minus returns, discounts, and allowances. Revenue is for your product or your services, so proceeds from the sale of products, but also potentially services such as installation, delivery, loading, repackaging, labeling, and other services as well. Returns, discounts, and allowances. A sale is not complete until the customer has successfully used the product and has paid for the product. Now we might go ahead and recognize the sale, but if we have an idea that a certain percentage of the product will be returned and it can be estimated, then typically what we would do is we would estimate that, and we would say, so for example, maybe we sold $100 worth of stuff, but we anticipate that $1 of it's going to come back. We might report net sales as $99, which would be the $100 minus the $1 we're expecting to get back. Since the status is not known at the time of the sale, certain allowances are required, and this will vary from industry to industry, especially if you think about like a bookstore at a college buying a lot of books anticipating to sell them to students, but a lot of those may get returned to the publisher because students don't end up buying the text. The cost of goods sold, or COGS, represents the cost paid to the supplier for the product plus any freight from the supplier. It does not include freight on material shipped from the distributor's location to the customer, but any freight from the manufacturer either to the distributor or from the manufacturer shipping directly to the customer would be included in the cost of goods sold. There is some debate on that. Depending, certain distributors may actually utilize delivery as a service, and they in essence may buy delivery from third-party carriers at a discount and then charge the customer the full amount. In that case, they might not include it in cost of goods sold, or I'm sorry, they might actually include even shipping from their location to the customer in cost of goods sold. But generally speaking, cost of goods sold represents the cost paid for the product and any freight from the supplier, not freight from the distributor to the customer's location. Gross profit, in simple terms, is the difference between what someone paid for the product and the price they sold the product. Also may be referred to as gross margin, would actually be more appropriate to be referred to as gross margin because it is a difference between what you paid for it and what you sold the product for. Unfortunately, when it comes to accounting, most distributors will use the term gross profit because it's so common in other industries. And don't get caught in the weeds about that. Gross profit and gross margin are typically the same thing when it comes to if we're talking about calculating dollars. But it's basically the difference between what you paid the manufacturer for it, including freight from the manufacturer, and what you sold it for. Operating expenses. This represents the cost incurred in providing goods and services. So basically, the cost incurred because of the type of business that you're in. So examples for a distributor would be shipping expenses, warehousing expenses, selling expenses. Sometimes may also be referred to as selling, general, and administrative expenses. You can see on the income statement that there are other expenses such as interest expense. All right, interest expense may be necessary for you to have your business open because you need to borrow money for it, but it's not necessary in providing the goods and services that you provide because it could be funded with equity that doesn't require an interest expense. So at the end of the day, operating expenses are those that are tied to the type of business that you're in. Operating income or loss. This is the profit attributable to the operation. In essence, represents the profit from the type of business or industry the company competes. Also may be referred to as EBIT, which stands for earnings before interest and taxes. In other videos I do, I'll refer to this number as EBIT, sometimes operating income, also sometimes operating profit. This a lot of times is what frontline managers are held accountable to, or their bonuses are based off, or whatever, because they mostly control this. This is from running the company, the operations side of the company, how much profit or loss that you might have. Other income and expenses. These are revenues and expenses that may be necessary to operate a business, but are not necessary in providing the goods and services in this particular operation. So a prime example of that is interest expense. Interest expense results when we borrow money to finance the capital that we need in our business, which again may be necessary to be in business, but it doesn't necessarily create an expense associated with servicing your customers. Income before income tax. The income earned by the business before allocating an amount for taxes. May also be referred to as net profit before tax, or NPBT. income tax or income tax expense. This is the amount of tax the business must recognize according to accounting standards. The amount of actual cash paid to taxing authorities may vary. There may be a lot of reasons for this. There's different ways of. One of the biggest reasons is the difference between depreciation that's allowed for income tax purposes compared to depreciation expense that's allowed for generally accepted accounting principles. Income from continuing operations is basically the amount of profit earned by the business minus the amount recognized for taxes. Non-recurring events. I hesitate to even talk about these in this video because from a frontline manager's perspective, which this video is mainly for operators, not necessarily accountants, and really not even for the executive levels that maybe deal with this as well, but they're realistic things that show up on income statements that you may need to understand. But basically, these are non-recurring events. These are business decisions that affect the business's net income, but not necessarily the business itself going forward. These events should not reoccur in the future. So, net income again equals revenue minus expenses, or basically the amount of profit earned by the business after all revenues and expenses have been recognized. And again, that's just some elements of the income statement, and remember that it reflects the results of an operation based on revenue expenses over a certain period of time, and that the simple formula is revenue minus expenses equals net income. Let's talk a little bit about profitability, which seems to go hand in hand with the income statement in most people's perspective. A company's profit is its net income, or revenue minus expenses. There could be operating profit as well and some other things. Profitability, though, is how well resources are used to generate profit, or the ability to earn profit. To measure profitability, the resources employed must be examined. These resources can be found on the balance sheet, which will be the purpose of the next video. And so when it comes to profitability, it's not just what you earn, it's what you use to earn that profit. I had a wise gentleman one time tell me that in life, no one ever judges you by what you do. They judge you by what you do with what you've been given. So if you're given more resources, the expectation would be higher profit. And so that's where the term, where we get profitability, is the ability to utilize those resources to generate a profit. Alright, and that is the end of our video on Introduction to Income Statement. Again, we covered the importance of the income statement, elements of the income statement, and we spent just a brief amount of time talking about profitability.